ETFs versus individual stocks, which one makes you more money? Most new investors face the same question: should you build wealth with ETFs, or focus on individual stocks? Both can grow your money, but they work very differently, and choosing the wrong one for your strategy can slow down your financial progress. Let's break it down with clear comparisons and real numbers. Start with ETFs. An ETF is a basket of companies you buy in a single investment. Instead of choosing one stock, you instantly spread your risk across hundreds of companies. A simple example is the S&P 500 ETF. Historically, the S&P 500 has returned roughly 10% per year on average since the 1950s. If you invested $10,000 20 years ago and left it untouched, it would be worth around $65,000 today. Add monthly contributions, and the compounding effect becomes even stronger. ETFs are stable because when one company falls, other companies inside the fund balance it out. That reduces volatility and protects new investors from panic selling. This is why many financial experts call broad market ETFs the foundation of long-term investing. Now look at individual stocks. When you buy a single company, your entire result depends on that one business. If you pick correctly, like the early investors who bought Nvidia under $20, the upside can be life-changing. But if you choose incorrectly, companies like Enron, Lehman Brothers, Blockbuster, or newer collapsing firms, the losses can be permanent. Individual stocks require time and research, analyzing earnings, competition, leadership, and industry trends. And even with effort, it is extremely difficult to beat the market consistently. Studies over the last decade show that 80 to 90% of individual investors underperform simple ETFs over a 10-year period. Now we compare them directly. Volatility. Individual stocks can move 5 to 10% in a single day. ETFs rarely make extreme swings because your risk is spread across many companies. Cost. ETFs have very low fees. Popular S&P 500 ETFs have expense ratios around 0.03%. There's no management fee for individual stocks, but the real cost is time and the risk of emotional decisions. Return potential. Individual stocks have higher upside, but also higher downside. ETFs grow slower but more consistently. Over long periods, the average investor earns more by holding ETFs because they avoid big losses and emotional mistakes. Time commitment. ETFs require almost no time. You can automate a monthly plan and let compounding grow your portfolio. Individual stocks require constant decisions, updates, and emotional discipline. Here's a real example. From 2014 to 2024, the S&P 500 returned about 12% per year. Yet the average retail investor earned far less, mainly because of panic selling and wrong timing. ETFs reduce this problem by being naturally diversified. So which option is better? For most people, the answer is ETFs. They offer stability, diversification, and strong long-term results with almost no effort. If you want simple, consistent growth, ETFs are the safest foundation. Individual stocks can be added as a smaller, high-risk section of your portfolio, maybe 10 to 20%, if you enjoy research and want higher upside. Many experienced investors use a combined approach: ETFs as the core, individual stocks as the satellite positions. The key is consistency. Stay invested, avoid emotional decisions, and allow time to work in your favor. That is how real wealth grows. If this helped you understand the difference, subscribe for more clear investing insights and like the video to help the channel grow.